Most people learn personal finance by accident, usually too late. In the next 7 minutes, I'm going to walk you through 5 specific finance mechanics that catch most employees off guard. We will start with the one that costs people the most: how your 401k match vests when you quit. Then RSU cliffs, the marginal versus effective tax rate myth, the only account that beats a Roth IRA. And finally, the IRS refund money waiting to be claimed before it expires. Each mechanic in 60 seconds with the rule, the trap, and the action. Let us start. Your employer matched 3% of your salary into your 401k. That money may not actually be yours yet. Vesting is the rule employers use to keep you from taking the match and leaving the next day. Your own contributions are always 100% yours. The match is different. Say you have a 5-year graded vesting schedule. You vest 20% per year. Leave at year 2, you keep 40% of the match. Leave at year 5, you keep all of it. A cliff schedule is different. You get 0 until year 3 or 4, then everything at once. Your employer schedule is in your summary plan description. Not all plans are graded. Some are immediate, illustrative numbers only. Your plan differs, mechanics, not financial advice. RSU vesting works 2 ways, graded or cliff. Graded means a portion vests each year, often 25% per year over 4 years. Cliff means nothing vests for the first period, then a chunk vests at once. The most common pattern is a 1-year cliff at 25%, then quarterly vesting after. At vest, the shares become ordinary income at fair market value. Your employer reports it on your W-2. They withhold 22% federal by default. The withholding gap matters. If you are in the 32 or 37% bracket, 22% withholding is not enough. You will owe at tax time. Many employees use sell to cover. The company sells just enough shares to pay the standard withholding. The rest is yours to sell or hold. Mechanics, not financial advice. Your marginal tax rate is not your actual tax rate. The most common money mistake in America is confusing the two. Marginal tax rate, the rate on your next dollar of income. If you are in the 24% bracket, only the dollars within that bracket are taxed at 24%. Not all your income, effective tax rate. Your actual federal tax paid divided by your total income, almost always significantly lower than your marginal rate. The mechanic. The U.S. tax system is progressive. For 2026 single filers, 10% on the first $11,925, 12% on the next chunk up to $48,475, 22% on the next chunk up to $103,350, and so on. The example: a single filer earning $100,000 has a marginal rate of 22%, but an effective rate around 17%. The difference matters when you decide whether a raise pushes you into a higher bracket. It never costs you money to earn more, you just keep slightly less of the marginal dollars. Subscribe for more money mechanics. Share with anyone who thinks raises push them into a worse tax position. Mechanics, not financial advice. State and FICA taxes are layered separately. The HSA is the only account that gets a tax break 3 times: going in, growing, and coming out. Going in. Your HSA contribution is pre-tax. It reduces your federal income tax this year. Some states also exempt it. Growing. Any interest, dividends, or investment gains inside the HSA are tax-free. Forever. No capital gains tax, no dividend tax. Coming out. When you spend on qualified medical expenses, the withdrawal is also tax-free. That is the third break. The catch. You can only contribute if you have a high deductible health plan. The 2026 limits are $4,400 for individuals and $8,750 for families. After age 65, non-medical withdrawals work like a traditional IRA, taxed as income but no penalty. Mechanics, not financial advice. HSA qualifying coverage rules apply. Every year, the IRS sits on over $1 billion in unclaimed tax refunds. They expire after 3 years. The mechanic. If you did not file a federal return in a year you were eligible for a refund, you have 3 years from the original due date to file and claim. After that, the money goes back to the U.S. Treasury permanently. The 2023 deadline is April 15, 2027 for 2024 returns. Common reasons people miss it. They had too little income to require filing. They were unemployed or in college. They had refundable credits like earned income credit but did not file. The fix: get your wage and income transcript from irs.gov. It shows every W-2 and 1099 reported under your social. File a return with that data. The refund check comes within 6 to 12 weeks. State refunds have separate rules. California is 4 years. Mechanics, not financial advice. That is 5 mechanics. 3 takeaways. 1. Vesting schedules cost most employees money when they quit, because most people do not read their summary plan description until the day they give notice. 2. The marginal tax myth makes people refuse raises that would actually help them. Effective rate is what you pay. Marginal is just the top dollar. 3. The IRS holds billions every year in unclaimed refunds, and the 3-year clock is real. Subscribe for more mechanics like this. We publish a 60-second short every day on this channel. The description has the link to every individual short for deeper reference. Mechanics only, not financial advice.